you for being here with us. On behalf of the entire team of Equirus PMS, I, Gaurav Sharma, welcome you all to our second virtual annual general meeting and the launch of our new fund, Equirus Core Equity. It's a lovely Saturday morning, and what's better way to start this weekend with some mentally stimulating observation. I would request all of my friends to please raise your questions in the chat box so that we can save time and ensure the questions are answered at the end of the panel. Here, I would like to invite Mr. Ajay Garg, Managing Director, Equirus, to please give us some short prelude before we start. Ajay, sir.
Yeah, good morning, Gaurav. Thanks. Good morning, everyone. It's a pleasure to host this event, and for the fifth annual Equirus Long Horizon Fund, and Equirus PMS as a product is now 5 years old. Thanks to the support we have got from the group and Equirus's 15th year journey. So we are sort of, pretty happy to work with all of you in achieving equity return desire for the investors. We are obviously, the last 6 months has been a very different times from what we have seen over the last 2.5 years. But in my various interactions in meeting a lot of companies now, I have never seen corporate India be so entrepreneurial, not seen the type of health of the balance sheets and the momentum they're expecting over the next few years. So we continue to look at opportunities to allocating equities, allocating institutions on the investment banking and the PMS and the capital market side. Obviously, we being an investment bankers tend to end up becoming optimistic on the outlook of the markets and the business. But after seeing 2 great years of performances, we have seen some consolidation, but we continue to see value in the market. And I think Viraj and my colleagues will be talking more about it. As a firm, we keep seeing the strength of the team. We have added a couple of more people to the team, Neeraj and Gaurav, who have joined us as part of the overall asset management organization. So we continue to invest in the business, and we look for your support in achieving the desired equity return expectations of everyone on the situation. With this ado, I would like to hand it over back to Gaurav to take the session forward.
Thank you so much, sir. I would now like to request Mr. Viraj Mehta, Managing Director, PMS, to start the panel discussion.
Thanks, Gaurav. Thank you, everyone, for joining us on a Saturday morning. We've had, this is our 4th AGM and 5th year in way of completion. The idea of every time having an AGM was to essentially tell you our thought process, what we have done in last 1.5 years, the thought process behind decisions. The idea is always to have two-way interactions and let people know how we think about all our decisions and think of it and be responsible for whatever actions that we have taken over the same time frame. So I'll just run a small presentation and post that. I'll be happy to take any questions that any of the investors or audience has. Is it visible now, Gaurav?
Yes, it is.
So this is the disclosure that my compliance team will never let me allow a presentation without the disclosure. So so all of the stocks my entire team is long on, and we continue to hold all of these stocks in our portfolio. So this is our return, and this is what we have achieved since the day we started the fund on 20th October 2016. If you were to divide this performance over 3-4 different time frames, once we started, we actually had a pretty good tailwind in terms of small caps doing well. We just started before demonetization. So post demonetization, we had a great run in small caps, and our fund delivered close to 60% in the same time frame. And this is not IRR. This is for that a year and 4 months, where our outperformance was closer to 22%. But more importantly, in the drawdown of 18 and 19, we were able to, narrow our losses, in the sense we were able to outperform by around 6-7%. But more importantly, we did not have any catastrophe where we lost like 70-80% from our purchase price and because the business was just wrong or the management was completely fraud. This continued even post the tax, but post the tax cut, we had a decent run up. But then COVID happened, and which is where we lost 28% in 1 month. Apart from that, we were actually up 15% in that period. And post COVID, obviously, everybody has had a great run, including us. We were up 260% in the same time frame and outperforming the index. Last 6 months, as it's been a slightly different picture in the sense, again, the same period as we saw in February 18 and 19, February 18 to August 19, small caps have started cracking, and the index is down, and we are down 12-13% from February onwards. And we have taken 1st of February because that is when the index started falling. We just achieved, and the index just achieved the peak before that. So we are basically trying to take peak to trough to understand how the performance has been across time frame. Before I actually go into each decision, the idea behind each decision is that in a portfolio of 15 to 16 stocks, we understand that if we are half decent or if we are good, we'll be right 6 out of 10 times. We are never going to be right 9 out of 10 times. We'll be at max right 5.5 or 6 times out of 10. But what is more important is that when we are right, how much money do we make? And when we are wrong, how much money do we lose? When we are right, do we end up making 200, 250, 300 percentages? And when we are wrong, how much do we lose? Do we lose like 80% or do we lose 20, 30%? So first we'll talk about what worked for us last year. We essentially last 1 year has been gone into buying stocks where we think there is high margin of safety for us. The valuations are incredibly in our favor because the businesses continue to do well, and there is large margin of safety in buying those businesses at that price. Second thing which worked for us is some of the older names which have continued to deliver performance, business performance, and relative stock price performance have continued to do well. But more importantly, we have got large amount of new money in last 6 to 12 months. And because we essentially follow a non-model portfolio, we have been able to restrict downsides in some of the new accounts because we've not deployed all the capital in one go. We have essentially deployed over a period of time, and some accounts or most accounts which are even 6-8 months old today still have some cash remaining with them. So we have been pretty prudent when it comes to buying new names or even older names at slightly unfavorable valuations. What didn't work for us, and I think the biggest example of what didn't work for us last year, and we should be more cognizant about it, is we bought a company known as Heikel early last year at around 180, $200. The company did very well for us. It went to 500-600 with essentially earnings going up 50-60%, but trailing multiple of 15-17 became 35x. But the business was getting better. Whenever in the past we have sold stocks which have gone up and business is getting better, we have ended up actually missing a lot more on the upside. A classic example of that could be we sold Alkyl Amine at 7,000 crore valuation when the valuations became 30-32x, and the company went to like 15,000-16,000 crore valuation post that. We sold APL Apollo at closer to 8,000-9,000 crore valuation, and even today, in spite of this fall, it's around 22,000 crore valuation. So we thought if the business is continuing to deliver, even though slightly egregious at 30-35 times, but probably 25 to 26 times 1 year forward earnings, we can still hold on to that. But one incident, the gas leak incident, what happened is whenever such incidents happen, in the past at least, we have seen that companies come out within 6 months without too much of business problem. And there have been multiple examples of that. You have had examples of Gujarat Fluoro or SRF or Naveen Fluorine or DV. There are like umpteen such examples where companies have come out of it. We just did not estimate the amount of business that could have been disrupted due to this problem. which when we realized, we took significant money off the table, but probably 30% lower from where the price was at that point. In new accounts, we did buy a couple of stocks which were at fair valuation and did not have large margin of safety, which is a typical buying behavior over last 5 years. And the last thing which did not work for us is that we have seen significant derating in cement stocks, which this I don't think anybody, including big funds on the street, could have envisaged post the sellout by Holcim to Adani's. So what we did last year is we initiated 4 new positions. We scaled down positions in which risk reward had become unfavorable. And we continue to maintain conviction in some of our older positions where businesses continue to be robust and businesses continue to deliver in terms of business performance. What are the 4 positions we have initiated? So we have initiated positions in Pratap Snack, where we bought between 700 to 800, average price being around 750, 780. I think this business will do significantly well. This business now delivers around 1400 crore of top line with 4.4 rupees of average realization, sells essentially 1.1 crore packets a day across 20 lakh retail touch points in this country. This business has essentially saw all the disruptions that it can. It has seen COVID where schools were closed, which was 25% of the buying. It has seen palm oil going from 70 rupees to 150 rupees, including COVID uptrend and war. We think, and they have survived and come out stronger. They've tightened their belt. The entire logistics of this businesses has been very well done up. When we will see now volume growth this year and some of the key raw material prices normalizing, we will see substantial uptick both in terms of I would say pricing as well as in business performance as well as stock price performance. If you were to ask me to pick 1 or 2 stocks out of the entire portfolio where we see probably one of the highest upsides in the portfolio, this name would be the first name that I think that would come to my mind today. The second name that we added was Vadilal Industries. This was again one business which was doing very well, both India and exports. Exports majorly are to US. Indian business was close to 600 crores. US business was 300 crores. But till 2019, US business was losing money and India business was doing well. 2020 and 21 saw India business not doing well because of COVID lockdown in the main season, which is the summer season. 2020 was lockdown and 2021 was Delta variant, due to which the sales just didn't happen. But US business kept on growing. Now 2022 will be, as in calendar 22 and FY23 will be the first year that this business will be seeing normalized profits from both the arms of the company coming on stream. When we bought, the market cap was closer to 800-900 crores. And this year we'll see the company reporting between 120 to 140 crores EBITDA on normalized earnings. An FMCG business available at 5-6 times EBITDA was absolutely unheard, which is why even in downturn during the war, as in when the war started in March, we continue to pile on to this company. And it is one of our largest positions today with close to 7.5% allocation. This is one more business that we added to in our portfolio. Gati was bought over by All Cargo, which has a strong presence in the entire logistics space, in its entire logistics chain. This was a very badly run business from erstwhile promoters. And this business was bought over by All Cargo. They brought a professional CEO who was the CEO even at Mahindra Logistics, Mr. Phil Sarkari. And he's turning around the business significantly by basically getting the nuts and bolts right, by basically let's say in Delhi or in NCR, which is the largest hub, from 4 hubs they've gone to 1 hub, which will lead to 2% savings in that business. They have essentially sold off all the non-core assets, including the petrol pumps to the excess land. And today this business is available at 1200 crore revenue for 1500 crore market cap. Such large runway businesses where there are only 4-5 national players in Surface Express are available at 1.2 times revenue is simply unheard. We think there is going to be large margin uptick in Gati from 2-3% EBITDA to close to 12 to 14% EBITDA over next 2 to 2.5 years. When that happens, we think this company will trade anywhere between 2.5 to 3 times revenue, if not slightly higher. Some of the competitors, if you were to look at when Spot On was acquired or where TCI Express trades even today, is closer to 5 times revenue. We see there is significant margin of safety when you buy a business like Gati, because things can only get better from here, both business wise and environment wise from here. This is the last business we added. So the company does food colors. It is one of the largest food color players in the country and globally as well. They make synthetic food colors. The company has put up a plant in Dahej, which will be potentially a game changer, which takes up their capacity from 3,000 tons to almost 6,000 tons. And they've also put up a dye intermediate plant for the same unit for internal consumption, which takes up their capacity by 4x from 4,400 tons to 17,000 tons. This will make Dynamic the second largest player in synthetic food color industry in the country. We think the trailing revenues of 250 crore do not really do justification to the scale that which this company is envisaging. If they are able to scale up, and it can always be 6 months here and there when it comes to manufacturing. But when they'll be able to scale up, we are looking at this company scaling up from 250 crore revenue to 700 crore revenue over a period of 2.5 years, which will mean we are potentially buying this at single digit P, closer to 7-8 times. And we have seen whenever in the past some of these ramp ups have happened, companies end up creating value both in terms of PE going up and earnings going up, which is what we think is a base case scenario for something like Dynamic Products. So now we'll talk about things where we or companies where we have scaled down our positions, where risk reward just was not favorable and business changed a little bit. So we sold Oriental Aromatics. We bought Oriental majorly here at around 350, 400 bucks. The stock went up to 800, 900 bucks, but the business performance started deteriorating where they were unable to pass the raw material increases to the customers. We were able to completely sell it at 800 rupees when the stock was trading at 3.5-4 times revenue and closer to 35-40 times trailing earnings, but more like 25-27 times normalized earnings. So we still think the company will do well from here, but can it generate significant return compared to some of the opportunities we were probably getting at that point, things like Pratap, or we sold it to buy things like Gati and Vadilal. We think the risk reward just didn't exist at that price. Also, we were a little concerned about the new pharma grade camphor capacity that Privy will be setting up. Till now, this guy is almost a monopoly in pharma grade camphor when it comes to supplying to some of the largest players in the country, and which is the most profitable segment for this company. So along with high valuation, when your largest product can potentially take a hit, that's not a place we want to be in. Manapuram Finance has been one of our oldest holdings. We bought roughly 80 bucks. We even bought at 60 bucks later. We essentially sold not because of the price, because price even at 190 was not that expensive, but the company started losing market share. When company starts losing market share and the competitive intensity in the industry is significantly higher than what it was to begin with, that is when we start scaling down the businesses, and we completely sold out of this business. And in hindsight, obviously, I mean, stock price is one factor, but a lot of financials have not done well. But the thought process will remain the same, irrespective of whether the price today is $90 or it would have been even 290. We would not be comfortable owning a business where the business starts and continues to lose market share. Heikel, and we've discussed enough about it, but essentially we bought Heikel really cheap at $180. It became $500-600, and which is when the incident happened. We thought they would come out of incident with a 6-month delay to their earnings and revenue scale up, but they started losing market share. Even, let's say, one of the largest COVID drugs of Pfizer, Paxlovid, which was supposed to be given to 2 large players in India, including Heikel, was given to 1 large player instead of 2, which is when we decided if the business is deteriorating, we don't want to then stay invested in such a business, which is when we scale down significantly. Rain Industries, the idea was to buy a commodity business at $100 a lot, where significant tailwinds would exist, and there was large operating leverage which was going to play out, and financial leverage which was supposed to play out. The reason, and it has done reasonably okay for us, the reason to sell Rain Industries or significantly scale down Rain Industries was Rain essentially has plants in 14 countries in this world. You realize that you understand the business in larger countries, but then energy prices in Germany goes up. Then there is an event in US, which a hurricane in US, which will pull down your factory for 2 months. I just think we just do not have the handle to track this company that well. And it's just not the risk reward that we are looking at, and which we realize later. Like, I mean, if somebody would have told me that there are not 5 factors affecting the company or decisions, but they're like 50, probably I would not have bought this stock instead of it being very cheap. Garware continues to be a monsterly good stock for us, but it has just become extremely expensive at around 50 times earnings, which is when we started selling this company. We continue to hold, these are the stocks we continue to like and hold. We continue to love Polycab. The business is a market leader, continues to gain market share, and will continue to do so. Slightly expensive at around 28 times current year earnings, but we think this business will trade at such premium valuation. This is more like an anchor in the portfolio. And you see, in spite of large copper price variation, they've been able to maintain their margins, which gives us even more confidence in the management and the business capability of the whole team. This is one more business. We have seen several ups and downs, but till now we have not sold a single share of this business. We bought this business when the business was doing 25 crore profit and 300 crore market cap. Today, the company will do 90 crore profit this year with closer to 1400 crore market cap. But the company is scaling up from 47 stores to 72 stores over next 4 years. We think the revenue can significantly scale up from 2200 crore to 5000 crores over next 4 years. And we think this organized, unorganized to organized will continue to happen in gold jewelry. And this remains our preferred play in the industry because Titan is the best player in the country, but it is also the most expensive. In the place that we are, this to us remains the most preferred play as of now. This is one company where we think there are a lot of triggers going forward. We bought Delta when essentially the casinos were closed at less than $100 in the portfolio. The operations have absolutely normalized post second half of February. We will see the new vessel coming operational in second half of 23, which will take up the capacity by 2.5x. And we have seen the online subsidiary Delta Tech Gaming. They have recently set up their IPO, and they have received all approvals to set the land-based casino, which is near Mopa, which is the new Goa airport. So we are actually very bullish on this company for a 3 to 4 year perspective. This company, Nosil, is we added February last year at 140, $150. We continue to like this business. The company did 17% volume growth this year. They will essentially use up their entire facility by September 2023, where they can touch to 2,200 crore revenues at current realizations. This company, even post that, will do debottlenecking. They are continue to gain global market share. They are an absolute specialized niche player. This was a game-changing capex for them. I think this is exactly what can happen in the in Dynamic as well, which is why we continue to like both of these companies. Birla Corp, the expansion has been completed. They have touched 20 million ton with completion of Mukutban in April 22. We will see margin pressure in Q1 and Q2 continue as well. But we continue to like their position as the one of the lowest cost producer in the industry. We think this is more of a sector derating which has happened, and you see all expansion plans from everybody, including Ultratech, Shri Cement, and Dalmia Bharat. We think the entire cement pack as a whole is a good place to look at today. We do not think what has happened in telecom will happen in cement. I think today large portion of the entire sector is valued below even gross block. Forget replacement value. You have companies which have 3,000 crores of gross block, 800 crores of working capital, and are trading at an EV of 2,200 crores. We think only in hindsight we'll realize probably this is one of the best times to look at cement. How do I think about future opportunities, right? We have still to deploy some capital. We think if you were to think about how things have shaped out in US and UK and Western world, they basically splurged free money that they did not have, which led to services to goods ratio or demand ratio was 1:1 in US, which has gone up to 3:1 in US, and which has led to egregious inflation in metal commodities, agri commodities, and energy commodities. Post the first wave, the first things to go up were metals, then it was followed by agri, and then it was followed by energy. We think the commodity prices will also correct in the same order. Metal prices have already started correcting globally. We think they'll be followed by agri, and which is also wheat is down 25% from its peak, corn is down 20% from peak, cotton is down. We will see that will continue to happen, and energy will be the last source to kind of correct. India has never had a big uptick in demand of goods to services to our historical past. We do not think, and even it is confirmed by the companies that we meet, demand does not seem to be a challenge. Raw material and gross margin seems to be a challenge. We are extremely positive on companies which continues to see demand, but where margins are hit today, because we think margins will normalize, or at least the stock prices today are valued like margins are going to stay here forever. If margins normalize, and we think there is a reasonable probability of that happening, we will see significant uptick both in earnings and stock prices of some of these companies, which may include some of your staples which we own, like Pratap Snacks or Vadilal, and we'll add one or two more to that basket, be it durables, be it your auto ancillaries, be it your cement. So this is what we have done. And when we see opportunities, I'll also, so first of all, thanks a lot for patiently hearing me for last 20-25 minutes. I'd like to take this opportunity to, introduce Gaurav and Neeraj. Gaurav has joined us from Tata and Avendus. He used to take care of the non-discretionary PMS at Avendus, and he's joined us to start our multi-cap fund, Equirus Core Equity. The idea is to provide the best, is to still provide the best risk-adjusted return to our investors, but with much lower volatility, and which is why we think Gaurav can do the exact same job with the same ethos and principle on a top-down basis, but more larger cap companies with the same principle. Neeraj has joined us as head of equities, and he'll be providing research help to both me and Gaurav and sharpening and scaling up our positions. So having, I'll now hand over the floor back to Gaurav, and he'll be talking more about Equirus Core Equity Fund. We'll take questions in the end. Gaurav,
Thank you, Viraj.
I'll just.
So let me just share my screen. Thank you everyone for taking time out and joining us on Saturday. It's a pleasure interacting with you all. So I'll be talking about the new strategy in the multi-cap space, Equirus Core Equity. This we have launched just a couple of weeks back. So 27th May was the first day when we punched an order. So Equirus already has a great product in the small cap space led by Viraj, and which has delivered substantial returns, 23% since inception versus 12% for small cap. But the management at Equirus actually thought that there is a space for large caps and mid caps in a client's portfolio as well. Right. So if you look at historically, how have both these spaces done? So there is a premium that small caps actually achieves at certain points in time versus the Nifty or versus the large cap space. This chart that you can see on the left hand side, this actually shows you the premium of the NSE small cap versus Nifty over the last 10 years. So there are times when there is a euphoria in small cap space and the valuations in that segment become very high. And there are times when there is a depression in that space and the valuations become really cheap. So these three bubbles that you see, 1, 2, and 3, these denote such times when the small cap valuations were pretty high. And the forward returns from these points have been in the favor of large caps. So, for example, if you had invested in large caps in the end of 2017, for example, the next 2-year returns on Nifty were up by 15%, and NSE small cap delivered negative 30% returns. Similarly, if you had invested in July 2021, the prospective returns, Nifty was up by 5% and small caps were down by 12%. Whereas if you had invested in these times where the small cap premium was much lower, in fact, small caps were at a very large discount.
Can you do screenshot? Can you control it?
Yeah, sorry about that. Yeah. And if you had invested during these times when the small cap discount was pretty high as compared to large caps, you would have made a lot of money in small caps. So there are times when, so there is space for both in your portfolio, and largely they trade in a certain range. Right now, we are at a place where, where you can invest in both the segments, but over time, you have to see the relative valuation differential and decide what is the segment that more of your allocation should go towards. So that basically and large caps by their very nature are, leaders in their businesses, have a capability to withstand the stress times much better. They have access to human capital, financial capital, and because of these virtues, they have reached that level where they, where they've transitioned to large and mid cap space. So while small caps can generate huge amount of wealth over time, they do so in a bit of a volatile manner. Whereas with large and small mid cap space, it lends sort of a stability to your portfolio. So that is the thought process behind this strategy. There was also a demand from investors, as I understand, that they wanted a product in this space as well. So this basically gives them some advantage in terms of diversifying their funds across the market capitalization curve. So coming to our investment philosophy, so the thought process kind of remains the same as Viraj has followed with ELHF. We do look for companies which have very solid balance sheets, which are highly profitable and increasing their profitability. More importantly, so companies which grow by internal accruals and where ROC and ROE keep on increasing over time. So we look for those companies. We also, obviously, growth has to be there. I mean, there has to be a large headroom to grow. I mean, some companies do kind of have spurts in growth, but we look for companies which have a very long runway for growth. So, in sectors which are related to, for example, consumption or investment, I mean, India offers tremendous opportunity in many of these sectors. So we look for sweet spots in those areas. Then, as I said, the growth should have a longevity. I mean, it shouldn't be that the company grows for a couple of years and then kind of fizzles down. There has to be a longevity to growth, and that kind of comes from your sustainable competitive advantage. That could be in any form. It could be brands, it could be network effects, it could be low cost manufacturing, it should be regulations that are favorable to a company or an industry. So all these actually lend you certain competitive advantages, which lead you to growth over a sustainably long period of time. And finally, I think the most important part is it has to come at a reasonable price. Whether it is a growth stock or a value stock, the intrinsic value that the company should have should be much higher than the market price that it is trading at. And that is the philosophy that we carry over from ELHF. And one of the reasons why ELHF has done so well is because they buy companies which are under-owned, which are undiscovered, which are ignored by the market, and therefore as market realizes their potential, the re-rating happens, and the EPS growth actually contributes to the returns as well. So to generate significant amount of returns, reasonable price entry should be one of the key tenets to look at. So if you want to say it in one phrase, it's profitable growth and longevity at a reasonable price. That kind of encompasses our investment philosophy in the strategy. Then, we believe that growth and value are joined at the hip. But point is that, there is a value for company. And if you buy it below, if the market price is significantly below that intrinsic value, then we will go ahead with it. We are not constrained by growth or value investing in the traditional sense of the word. We do, as I said, we do prefer companies which require little capital to grow, which has strong balance sheet, have certain durable competitive advantage. We do prefer companies which are disruptors rather than getting disrupted. So you would find a lot of sectors being susceptible to large scale disruption these days. So some of the key buzzwords being EVs or e-commerce disrupting the brick and mortar retail, for example. So everything being equal, we prefer disruptors, and we tend to avoid disrupted companies. So that is one area where, just to tell you how we think about investing process. We are contrarians by nature. We don't believe in momentum investing. We don't believe in buying anything at any price. There is a buy zone, there is a sell zone, and there is a hold zone for every stock. So we are sort of contrarians by that way, in the sense that we look for companies which are under-owned or which are ignored by the street, because that is when you get the valuations at a really reasonable level. We are looking at building a portfolio of about 20 stocks plus minus 2. So that makes your average stock weightage of about 5%. But depending on the conviction level on a particular stock, that could range between 3 to 4% to 8% in case of high conviction ideas. We don't have a market cap split, fixed as of now, but generally you would see that large caps would account for about 50-60% of the portfolio. 20 to 30% would be mid caps, and 10 to 30% small caps. This might change over some time as we, depending on what sort of market cap curve we are more comfortable with, and we think should do well. But this is generally the split that is there, that is going to be. Our typical holding period would be 2 to 5 years. There will be certain core allocation in the portfolio which will be for a longer period of time, but there will be certain more tactical plays also which will play for a slightly lower period of time. But mostly it will be the core allocations will be for a much longer duration. So this is where we look for ideas. So looking at multi-cap and playing in the large and mid-cap space, we have to look both top-down as well as bottom-up. So we do have certain preferred themes in the market. So for example, we are positive on themes like increasing internet penetration in India, financialization of savings in India, anything which makes money, helps move money from physical to financial assets, be it mutual funds, banking, insurance, broking, any of these. We are very positive on the export theme from India as well. Although near term there could be some pressures because of the likely slowdown that could happen in the global markets. But to my mind, export story from India is more about India gaining market share rather than the growth of the overall market itself. So we do look for opportunities there, and if we get reasonable opportunities, if stock prices fall significantly there, we will look at that space very closely. And lastly, the capex, private sector capex, we believe is likely to pick up in some time. I mean, the latest RBI figures suggest that we have reached about 74% in terms of capacity utilization, and as that goes up further to about 80% odd, there and companies are sitting with very strong balance sheets. So as demand keeps on recovering, companies will have no choice but to keep investing in capacity. So that will lead to a private sector capex over the next 3 to 5 years, in my view. So that is also one area that we are looking at in terms of top down. In terms of bottom up, again, once you have identified these themes, then what is the best way to play those themes? That is one. But there could be some companies which might not fit any of these themes, but the company itself might be doing very well, might be taking away market share from competitors, looking at newer geographies, newer products, newer markets, and or there could be some special situations like like management change or spin-offs. So we do keep an eye on such opportunities as well. So these are the areas where we look for investment opportunities. But all said and done, it has to fit in our investment philosophy of profitable growth with longevity and at a reasonable price. So I've taken you through all these. I mean, the sectoral preferences and all remain the same. I mean, what Viraj has already said. I mean, we are looking very keenly at auto, cement, CapEx related themes, and because these are right now available at very reasonable valuations. So this is the typical, target portfolio plan. So most of the portfolio will be core long positions, and there could be some opportunistic plays, some tactical plays, which will be for a relatively shorter period of time. And this could change slightly over time, but more or less the portfolio will comprise of the longs only. What are our exit strategies? So one is, when fundamentals start to deteriorate, when you have an inkling that the investment thesis that you bought the stock with, that is not playing out, or the environment has deteriorated beyond repair and substantially for the company to deliver on what our expectations were. So that is the time when we will look to reevaluate. And lastly, if there is any corporate governance issue, that is the time when we will definitely look to exit the stock, because corporate governance is one of the most important things for us. And lastly, if we find an investment idea with a better risk reward at that point in time, and we want to make space for that in our portfolio, that is the time when we will look to exit an existing position. So coming to the team, so Viraj and Siddharth were a two-member team earlier. Last 3 months, we have substantially, increased the team strength with Neeraj coming in and Rushabh also joining us. So with a 5-member team, I'm pretty confident that we'll be, coming up with ideas, and more frequent ideas will be relatively much easier. And we should be able to, come up with a very reasonable portfolio over time. Lastly, you would find many multi-cap PMSs in the market, right? So where we differ is in basically 2 aspects. One is that, like ELHF, we follow a non-model portfolio approach. So clients who come in at significantly different dates will have significantly different portfolios. The stock weightages would be different, and even the stocks themselves at times would be different. So we don't believe in buying stock X at 100 rupees and the same stock with same weightage at 150 for another client, because that totally changes the game, especially in the large and mid cap space. So portfolios would be different for different clients because if the entry point is substantially different. And secondly, we'll try to have slightly more differentiated ideas as compared to other portfolios. So we are unlikely to buy the same names that we would, come across in most of the portfolios. I don't need to take the names, but you would be aware, their valuations are pretty high, and the perceived quality is pretty high. So unless we get them really cheap, we are unlikely to buy them. We are likely to have more differentiated ideas because we feel that you do a good job only when you try to identify, those ideas and try to give diversification in a real sense to the investors. So those are the two aspects in which we are trying to differentiate versus other PMS managers and mutual funds in the same domain. So with that, I'll hand it over back to Gaurav to take you through Q&A. I'm sure you'll have plenty of questions. Thank you for your
Gaurav.
time.
Thank you, Viraj. I would like to start the Q&A session. So we can actually start the questions. Viraj, if you may, you know, help us out.
I've read the question, so I'll start answering. Yeah, no problem.
So here the first question actually is from Sudeep.
Gaurav read the questions.
All right. No,
Okay.
because Viraj, we need to raise that question because questions won't be heard by others. So actually they can't see them. So we need to raise that questions. So Sudeep Dev have raised the question is that what is your exit strategy and what is your downsizing strategy on the portfolio, as and when he wants to understand about Repco, Hycle, and he also questioned about Gujarat Ambuja, as the stock has rallied about 80% and after Marcellus has bought into it. So would you like to not sell it again and re-enter it at a lower end?
Yeah, so no, I mean, we are not a trading firm, right? The whole idea is to not, and there will be times where stocks go up 30, 40, 50%, then they will probably fall 30%. But till the business is delivering, which is clearly the case in Gujarat Ambuja, I don't think I would like to, because I have no ability or capability to understand that whether this will rally only till here and then fall and then not go up in the future. I think, at least to us, it doesn't justify, or we do not understand that. So we will essentially stay away from trading in that respect. Till the business is delivering, we would like to stay with the business. And I think similar question is asked by Shagir as well on Hycle and Repco. I think we've discussed Hycle enough. I think Hycle obviously delivered very well, very quickly, but the business was delivering at that point, right? I mean, and sure, we could have had a year where Hycle would not have performed stock-wise, but if the business would have kept delivering, the stock would have done well even in future, right? We only decided to sell when they started losing clients. The idea is that we do not take a call just based on stock prices. If the businesses are delivering, slightly egregious, and it wasn't like it was trading at 50 times or 70 times earnings. It was trading 30, 35 times, which was a little expensive, but I don't think, considering the market, it was absolutely out of whack. In hindsight, obviously, it looks very different because the earnings have completely changed, because they've lost 3 clients, and which is why we sold out and took the decisions that we took. And in Delta, which is what again Shagir has asked, Delta continues to deliver. I mean, stock price is corrected because a large investor has thought of selling it. And again, I have no clue why somebody would buy or sell. I mean, we do not I mean, it's not my place to, judge probably the best investor India has seen, or his decision on to buy or sell. But obviously, when there is a large sell by a large client or a large investor in a firm, but if the business is continuing to deliver, even if the stock is corrected 30-35%, but I think if the business will do well, we still think we will continue to own the company. We will only think about selling the company if the business dynamic changes, and not just because the company has, or the stock has fallen. Like, I think an average stock in last 6 months has fallen 35%. Almost, I mean, and there was this data shared by Nuresh on Twitter. He said that 45% of the stocks have corrected 30% or higher. So it's fairly possible that, on an average, stocks have corrected that much. And did I know that in the past? If I would have known, I would have sold everything and bought everything today, right? But I just think we only know that in hindsight. And we also sold Repco to a decent extent, but we cannot sell anything at any price, right? I mean, we sold to our price, but if it starts falling below book value, then below that is just like we don't buy anything at any price, we just don't sell also anything at any price. I think at some price everything becomes ridiculous, and we will not like to go ahead and sell stocks just because I don't want you to look at that 1% or 2% allocation in your portfolio, because it may become an irritant. We just don't do things because we don't want you to see it. We will only do things what are right for the investor. And if it is not right for us to sell that stock at that point, we will not go ahead with it.
We have a query regarding Igarashi Motors. Your views, please.
So Igarashi, we think, so we essentially bought Igarashi because they were scaling up their business in DC motors. They were essentially doing very well. The parent Igarashi was talking about sourcing more from China. We saw the plant, we met them, we understood and they were also growing very well in BLDC. I think the business will continue to do well. They faced headwinds in terms of steel prices in last 2 quarters. I think by Q2 next year, I think that will be significantly behind us. And we will, and we think both in ISJEC and Igarashi should be 2 businesses which will see significant margin uptick once from Q2 onwards, because the major raw material prices which they were not able to pass on have dropped significantly in last 2 quarters. In last 2 months, actually, not 2 quarters.
Mukesh has questioned, what has been your learning from the cycle and what would you apply in your future?
Yeah, I think we've gone back and forth on this. I don't know why you keep bringing this up.
So Harshvardhan has been asking, what has been a good time about entering into cement sector and what are the key triggers for you to buy them?
I think this is a great time to look at cement sector. Yeah, I think in general, whenever a segment goes through such derating, if you don't think the sector is going to explode significantly going forward, I think it should do reasonably well from here. Yeah.
We have some questions. So it's a non-equity question. Maybe Ajay sir would answer. Why so many offices in Kerala?
That's our largest wealth market. We have a significant presence in that market. So that's the reason why we have so many people, because we have a good presence both in Kerala and Middle East through this presence which we have in those offices.
Okay, thank you. When you are buying a particular corporation at a certain price, keeping in mind the margin of safety in that price, would you still average up as and when you need to deploy more funds and on your bucket of stocks? And what would you ensure in the margin of safety for the new investor coming on board?
So which is what we have done last year. So we will not buy things at egregious valuation. I think more important than the price, it is the valuation at which you're buying. We have not gone above a certain valuation. See, we may buy something at 10 times, it may not remain there. But if we think the fair valuation of this is 20 times, and even if 10 times move to 15 times and earnings move up, stock may look expensive optically because it's moved up 70-80%. But in terms of valuation, it still looks reasonably cheap. So we kind of are okay buying it to a certain valuation. So that's how I would think about valuation and not just the absolute price. I'll also answer. Mukesh asked about the learning at on Heikel. I think again, I think the learning is to be a little more, I mean, again, not superimposing. I think the history on multiple of stocks or multiple of your investments in future tends to remain the same. I think if the outcome would have been different, let's say, for example, if we didn't have Heikel, but we had Gujarat Fluoro, which had fire in its plant, but the stock went up from 2000 to 3000, the question would have been very different, right? I think it's always, in hindsight, I think it's fairly convenient to kind of, flip-flop on decisions. I thought that such incidents have happened in the past and have not affected companies so much. Even in future, I think probably it was an inapt or probably not the best solution and the company could have done, and which is when we realized, we kind of thought it is important to scale down our position. Could we have done it at 500? Imagine if we would have done it at 500 and the companies would have continued to deliver. The question would have been opposite, that why on a small thing like this, which has happened in multiple more companies, why did you sell, right? So I just think it's not easy easy taking a decision based on one incident. It's, you have to think about the past and how it has happened and how it has played out, and which is what we'll continue to do in future as well.
The next question states why the logistics sector trades at 30 PE. Or maybe it is related to a stock, but logistics sector in particular.
Yeah, I mean, I think this sector will continue to see. How does a PE of a company gets defined? The PE of a company gets defined because of the longevity of growth, the profitability, and the ability to take market share. I think this sector has all the good things, right? From longevity of growth, ability to improve market share, and profitable growth. So which is why some of these sectors have large tailwinds for longer time, which is why they trade at a valuation they do.
Viraj, do you have any view on the newly listed chemical company Ather?
No, I don't.
Okay. We have next question from Adbhut. Sir, given that a lot of chemical companies are facing the RM challenges and the freight cost issues, would you look at those companies that have maintained or even improved the GMs in these days? If yes, then why are we avoiding chromium, barium related chemical corporations that has been doing very well?
I think this is very specific, and I know the companies he's talking about. I think we'll, what is not there in the portfolio, I think we'll kind of avoid this at this point.
We have a call for question from Mr. Sunil Dhanuka from Nigeria. So it's early morning out there. Bharti Airtel is heavily indebted and loss making. Share the logic of adding it in the portfolio. It is for Gaurav to answer. Gaurav, would you?
Yeah, thanks, Gaurav. So, Bharti, you're right that the debt level is high in absolute terms. So if you look at the debt level that was last reported was 1.6 lakh crores. And if you exclude the spectrum liability related obligations, the debt would be close to about 1.15 lakh crores. And if you look at the EBITDA of the company in FY22, they made something like 55,000 odd crores. And next year's, if I look at projections, the EBITDA is likely to be, I think around 75-80,000 crores. So when you look at the net debt to EBITDA number, that isn't that bad. That doesn't look very bad. This is an industry which has to keep on making investments in things like spectrum and infrastructure. So debt levels are likely to be high in this in general business environment. But when you compare it to the EBITDA that the company will make, the debt level isn't that significantly high. Why the company reported a net loss? The loss actually happened in FY21. There was a reported loss of about 26,000 crores. This was because the company had to pay AGR dues to the Department of Telecom of about 23,000 crores. So this was largely an extraordinary income. This pertained to a case which was going on for almost 2 decades, and the Supreme Court actually ruled against the telecom companies, and therefore they had a large payment liability for which they made the payment in FY21. So that was the extraordinary payment because of which you see the losses during that year. But if you look at the adjusted profits in FY22, they did about 3,000 odd crores. In FY23, the profitability is likely to jump significantly, multiples of that. But more importantly, if I look at the free cash flow that the company is likely to generate, I think they will generate something like 25-30,000 crores of free cash flow in FY24. Which means that on that basis, from a price to cash flow basis, they are trading at about 15-16 times. So looking at it from that perspective, it's pretty cheap, in terms of valuations. So to answer your question, there was a loss in FY21 because of the extraordinary payment that they had to make, which is non-recurring in nature. And the debt is high in absolute terms, but when you look at the EBITDA of the company that will make, it's not it's come down significantly from where it was. And given that there is a consolidation in the industry, it's by all practical measures, it's a 2.5 member industry now, 2.5 player industry, and the third player is rapidly losing market share to Jio and Bharti. And ARPUs are which are currently at about 163 rupees for Bharti, those are likely to go up to 200 and 250 over the next 2 years. And all of that actually flows into your EBITDA and your bottom line. So operating environment will keep on improving because a third player is likely to continue to lose market share because their viability itself is under question. So it's a consolidating industry. It's an industry in which the pricing power is coming back and pricing is improving, and debt from very high levels has already come down significantly. So we should likely see significantly better days ahead for both Bharti and Jio.
The next question is from Sagir. He would like to know, why don't we hire a technical analyst to protect the downside or understand the market momentum? If Viraj, you may answer. You're on mute, Viraj.
Yeah, so no, I think we are not a trading firm, right? So I think it's the mandate of the firm is to protect downside. See, you can't have upside of a long only firm and downside of a technical firm. I think those two generally don't go hand in hand, right? I mean, I think the mandate is not to, and we have seen that in the past, right? I mean, we have seen that, let's say Thangamel, for example, corrected from 400 to 250 before it became 1200. So if I would have had a technical analyst, I would have sold it at 300. So what happens in that case? So I just think it's a different mindset which is required to be an investor and a long only investor in small cap listed equities. It has to be a little bit more pipe kind of a mindset rather than, or at least that's the mindset we have. We have no intention of changing the philosophy as such, because this is what has worked for us, at least in last 10-12 years. And we will continue to do the same thing to the best of our ability, rather than just thinking on one time frame and trying to change philosophy on every time frames will essentially, I think, will do us more harm than good.
Next question is from Varun Sheth. He would like to know the execution risk at dynamic products, as there are significant delay and the cost overrun already.
So that is all behind us, right? So delay has happened and we have bought post the delay and the cost overrun, right? I mean, we know what has happened, and which is why the stock was available where it was available, and which is when we have bought. So, but now the uptick in revenues, both in food colors is there, and they will see a significant uptick in food colors. Dyes intermediates might still take a little bit more time to ramp up.
Next question is from Naval Saini. How do you maintain the strategy or the discipline in small cap as your AUM keeps increasing?
So restrict the AUM to a certain level, which is around double of what we are today, slightly north of double of what we are today. We are in no hurry to invest. We will only invest as and when we find opportunities. I mean, and it can work or for or against us in different time frames if we sit on dry powder, if the opportunities are not there. But I think over a longer period, that turns, at least to our understanding, that is the best way to buy things at the valuation that we buy, rather than trying to, because I mean, we are not a relative fund, right? We are not a mutual fund. We are not trying to compete against your index. We are saying that what we are buying is 15 businesses, and we need to buy them at our valuation. Now, whether it means buying them today or 6 months out, where the valuations are in our favor, is the only thing we would like to constrain ourselves to.
Next question is from Sagir. I understand, but the question has already been answered in terms of valuation, what you have put it across. So I think we should move ahead. We have next question from Parthiv Shah. He would like to congratulate for the team on the annual AUM that we have actually grown from. He would like to know about Vadilal. Are you comfortable with the structure like brand in the private company, a separated listed company of Vadilal Enterprises? Is that the reason why the valuation are low?
So brand is in a different company that is there in a lot of companies actually, and a lot of companies pay brand royalty 0.5%, 1%. So these guys pay around 1%. I think it will go up to 1.25%. But even after that, if we are able to get a company at like 5 times EBITDA, and who will continue to grow at 15% in a segment that it is, I think it's a super space to be in.
You would also like to understand about ISJEC, where the percentage of order book can have some inflationary impact, and what is the fixed pricing on the kind of books that.
So I think that part has already played out in Q3 and Q4. I think Q2 onwards, you will actually see deflationary helping them in terms of margins. Their order book obviously is half and half in terms of fixed and pass through, but which will help them in Q2 going forward.
One of the questions that have been raised: how do you define risk, and how do you size your positions, and the kind of drawdowns you are okay to take?
See, drawdown we can't help, right? We can buy something, but the marginal seller defines the drawdown, right? So, how do you see, till the business is doing well, we are okay with drawdowns. It is only when the business doesn't do well is when you got to understand that do we want to continue to hold on to the business or not.
We have a next question from Rohan Shah. His question is related to Manappuram. Isn't the market share in lending easy to attain by simply lowering the lending standard or yields? At the current market price, it seems Marker is only pricing in gold book, which essentially has no credit risk. Others have already entered and exited the space, as they can't compete with Manappuram or Muthoot operationally in the long run. Profitability as well. No views.
I think the profitability will come down for the whole sector significantly. If you were to look at some of the banks, you look at HDFC Bank's annual report. You look at how they are scaling up. You look at ICICI Bank. Some of these players who have now, or you look at IIFL, some of these players who have come in will bring down the yields, which will significantly depress the ROEs for a much longer period of time. I agree, at CMP, you have nothing to lose in Manappuram. But how do you make big money, right? I mean, if I buy Manappuram at $90, and again, we don't own Manappuram, but if you buy it at $90, how do you make $300, right? Because that's the only reason you will buy it today. I just don't see that happening, right? Till the growth and profitability returns, that seems like a distant future. Today, downside is protected, but do you see a way to make much bigger upside? At least at this point, I don't. So, which is why we don't own it.
We have a question from Ronak, who asked you about what is the current holdings where you think the opportunity of cheap valuation and averaging.
So, I mean, almost, I would say 70% of the portfolio we can definitely average, right? If we put more money, but there is also portfolio allocation. So within the same portfolio, it's not as if that we will essentially keep buying more if it is a certain allocation and the stock has fallen. So if it was 7% and it has become 6%, we'll not buy just because it has become 6%, right? It has to deliver on performance before we kind of buy.
What's your view on freight corridor, dedicated freight corridor? And the next question would be for Gaurav, which will be TCS entering 5G space. So first, Viraj, please state your views.
So I think it's a great thing for the country. I just do not know any singular player we can take advantage of through that. But it's a great great thing for the country, and you will see a lot of infra spend there.
Gaurav, on TCS versus Airtel 5G space.
So I don't think TCS is entering 5G space in the sense that it is going to compete with the likes of Bharti and Jio. TCS is more of an enabler, because whenever the 5G technology is laid out, you need a lot of support, network support, software support, which actually companies like Tech Mahindra and TCS provide to companies across the globe. So I think it's more of an enabler. One area where they can actually compete is in terms of private networks, but that is a very small part, and is likely to remain quite small for the next several years, because the addressable market there is pretty small in India. The use case is still not developed for private 5G networks. I mean, that goes into things like IoT, autonomous driving, etc. So if he's talking about that, then yes, the government has in principle awarded, enabled the private sector, private enterprises to bid for 5G spectrum, but use case for that is very limited and will likely remain so for several years. And in any case, most of these companies' revenues actually comes from retail customers, so that business is unlikely to get impacted. But more than that, I think TCS is and other IT companies are more of enablers in setting up 5G networks and providing software for them.
Um, uh, Neeraj, who's the head of research, do you have any views on TCS on the same?
No, I saw that question. No, yeah, no.
Okay,
Too small for us.
What's your view on corporate governance with Vadilal Industry?
I don't think there is any large corporate governance issues there. I think it's managed reasonably well. I think so. No, I mean, except the structure, which is a little weird because of the earlier regime of sales tax and VAT. Except that structure, I don't think there is any other corporate governance issues as such.
Again, Viraj, your views on Gujarat Ambuja exports, and does that the corn segment in commodity link, or how do you feel about the global corn prices falling?
So yes, I think Gujarat, but so global corn prices have nothing to do with India corn prices. India corn prices are irrespective of global corn prices. See, we have to think about Gujarat Ambuja as a converter. Like, let's say how we bought APL Apollo or Polycab. They were the best converters, the lowest cost converters in their space. Gujarat Ambuja is the lowest cost converter of corn to starch in its space. It is because it is the largest, and it is continuing to gain market share in the industry. So, I mean, 1 year the margins may fall because of commodity loss here and there, but over a period of time, the lowest cost customer, the lowest cost producer, and the converter creates a large amount of disproportionate wealth for its investor, which is how we think about Gujarat Ambuja. Already, it has done very well for us. I mean, the stock price may not go anywhere for some time, but I think post Malda and one more expansion that he is doing, we will see a large uptick in cash flows even from here over next 3 years.
This question would be for Gaurav and Neeraj together. What's your view on Tata Communication is getting into 5G? Anyone can take it forward. Gaurav, please initiate.
Sure. So again, I think this is more related to the private captive networks that they are also looking at. I mean, I've also read that L&T has also been talking about that. So these are more related to the enterprise side of 5G, which we've already mentioned that has very limited use cases as of now. Since it's a new thing that is coming up and futuristic sort of a technology, as I said, it's used in more of automation and autonomous driving, and things like robotics, etc. I mean, every company is getting excited about it, but this is a very evolving kind of a space and futuristic space. We'll need to see how the whole scenario evolves. But they are not likely to get into the B2C part of the telecom business, B2C part of the 5G spectrum, where these traditional telcos actually are likely to derive most of their revenues from.
So next question would the client, Mr. K.R. Srinidhi, he would like to know what is the expectation on the portfolio creation for the next few months as the bearish market sentiments are coming into picture. Spread of deployments on a monthly installment basis should be done, or deploy 40 to 50% of the money immediately and then over a STP mode.
See, I mean, for whatever money that, and again, I don't know whether market will remain bearish for 6 months or 6 years or 6 weeks, right? For me, it's a little difficult to kind of think. What I do know is what businesses are doing, how they are valued today, and what we think the fair valuations of most of these businesses should be 3 or 4 years out. That's I think the only variables in our hand and how we can function. If the volatility does scare you a little, I think what you have mentioned is perfect, is to think about deploying 40-50% upfront, out of which we'll also deploy only, let's say 60-65% of it, and then do the STP for the rest of the amount. That is fairly possible.
Anay Shastri has a question about the Indian economy and especially which will affect the small cap industries. And
Can't hear you, Gaurav.
oh, so sorry. Anay Shastri has raised a question about what do you think about the Indian economy which will affect the small cap industries. Can we get the rationale of those stocks in the communications?
I think this is the best we can do, right? We write a quarterly letter where we talk about one of our investments in most cases. I think making rational, I mean, we are not advisory service. It just becomes a little complicated because that gets then circulated to our competitors and it just takes away the edge that we have. So I have no problems with discussing the rationale with our investors, which I do on regular communications, but to make it public will be a little more challenging and difficult. Yeah.
What's your view on the metal sector and when do you see the revival? This is from Nikita. Small cap valuation get more stretched.
Yeah, but imagine, I mean, we can, if we know that it will keep correcting, right? I mean, if it goes 25% up tomorrow, the same question can easily be reversed, that why were you sitting on so much cash, right? Idea is we do not know, right? I think as human beings, it's just very easy to superimpose what has happened in last 6 months, to superimpose the same thing on that. The same thing will happen over next 12 months. Generally, it is not like that. So we have to, at least as investors or fiduciary or as somebody who's managing your capital, what we try and do is not think about where the stock prices can be a month out or 2 months out, but whether at this price does it make sense for us to buy or not. I think the lesser the number of variables we keep in our investment decisions, the more efficient we will be. Which is why we think we can't really judge where macro is, and we're not really good enough to judge that. So we can only answer one question, which is, does it make sense today at this price or not? I mean, however simple it may look, but I think that's the most important question and the crux of the argument.
We have one more question just came in from Narsimha. He wants to know a view on semiconductor sector opportunity wise for the next 5 to 10 years.
I think there will be a semiconductor glut in the world in next 2 years. So anybody who is going to be in semiconductor globally, and India does not have semiconductor producers, but the amount of capacities which have come in semiconductors, I think there will be glut 2 years out.
That's all the question that we had for now. We can either wait for a minute for new questions if in case, or would you like to?
No, I think we can finish. So thanks a lot everyone for your time. And hope to see you in person sometime. If anybody comes to Ahmedabad, happy to host you at our office. Please drop us a mail or please drop Gaurav a mail and he'll be more than happy to do that. And we'll keep having such interactions from time to time. Ajay, if you have anything to finish.
No, I think sort of good to see the question. There were also some questions about investors talking about the current volatility impacting their performance, and obviously in equity, we, as you rightly said, it's very difficult to look at the whole approach here is not to look at things from a short-term point of view, but we try to keep doing best in terms of what our capability is, and very happy the way we have grown from in 5 years to 550 investors, and we keep looking to add to this number.
Thank you so much. I would like to express my gratitude to our panelists and to our attendees for your presence and contribution to make this webinar a great success. Thank you, Ajay sir, for your inspiring and your encouraging words. Thank you, Viraj. Thank you, Donald sir, who is a co-head for investment banking, managing director. Thank you all for attending this call. We may conclude the call for today. Thank you so much. Have a great weekend.
Thank you.